Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Welcome to another edition of the podcast for the Corton-Aemelia Quant Fund, where we attempt to take the emotion out of investing. I'm Mark Deriet, the founder of Amelia Capital Management Corp., an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital Inc. Corton is the investment fund manager and portfolio manager of the Corton-Aemelia Quantitative Fund and its underlying fund, Corton-Aemelia Quantitative Fund LP, each a related issuer of Corton. As usual, that's my mugshot in case we've never met before with my background, and we'll get right into it. So last month, there was what's known as a momentum crash, where the factor falls out of bed pretty quickly. And here I show the Goldman Sachs Momentum Index and the 5-week rate of change. Why 5 weeks? Because that at the time was taken off the highs. And you can see down 20% in a very, very short order, which is pretty rare. You know, only exceeded by the tariff tantrum or COVID or the great financial crisis. And unfortunately, the fund was not unscathed either. The fund was down, the biggest drawdown we've had, 5.1% on the month. That brings the net return, and this is an estimate. We don't have the final NAV, I should state that. But that brings the return since inception of last May to just over 25%. That's a CAGR of 18.5%. The beta is still quite low at 0.5, resulting in a Sharpe ratio of 1.7. But certainly sides swipe to our process, unfortunately. No factor works all the time. And no factor works all the time. And frankly, we had quite defensive posturing, which we'll show on the next slide. So the blue line on the left is the gross returns of the fund versus the TSX in red. Not that we have necessarily a benchmark. We're trying to make absolute dollars, not relative. But in mid-July, where I pointed out that vertical line, you can see after that point, the blue line, unfortunately, had quite a big drawdown. And the positioning of the fund on the right shows that it was very, very defensive in mid-July. We had a portfolio beta of just 0.19. We had net exposure of 76%, 108 long, 32 short, cash of 8.3%. And the longs were very heavily tilted to defense, more than 2 times the benchmark weight in defensive things like utilities and pipelines and so on that tend not to swing around too much. And there's another nuance that we look at for risk. It's called the average true range. And this is the expected volatility of a stock over a day or a week or a month. And we just circle in blue there, the weekly ATR on a weighted basis for our fund was 2%, which is if every stock were to swing as much as it typically does, at the same time, you would expect the fund to swing by 2% up or down. So that's a very, very low number, but unfortunately, we had a lot of pucks not going our way, essentially. So in the month of July, a number of pucks didn't drop our way, frankly, and a lot of them have nothing to do with the AI trade that was unwinding. It's just a lot of other momentum-related names started to go the wrong way. And that's both from the long and short side. So on the left table, we show the biggest negative contributors for the month of July in the fund. And you can see it is a mix of long and shorts that went against the way that the fund was positioned. So we will turn now to our market indicators, and still a lot of green lights. There are still some yellow lights in the indicators that we watch, but the market is making new highs. So we say, don't fight the tape. So we'll go through a lot of these indicators and try to make sense of this volatile world. So the S&P has broken out to new highs, and that base target's around 8,000. It did spend a number of weeks consolidating this choppy range, but never broke down, never went into that yellow light territory, below the 100-day in blue, or the weekly trender is that green staircase. They acted as support, and we're breaking out to new highs. And we did get a little bit cautious in early June. The vertical red line shows that was the first big down day kind of against the uptrend that we saw. And that was the first shot across the bow, if you recall, of the AI trade. And we measure this by a 2 deviation event to the downside on the S&P, which is 2.2% or more. So we got that trigger in early June, and that puts us on alert and makes us much more cautious. You can see the last time that happened, the vertical black line was in early to mid-October of 25. And after the big ramp up off the tariff lows in the spring, that did kind of change the character of the market back then. We did make new highs, but it was much more sloppy. The global equally weighted index, recall this is a basket of around 3,000 stocks around the world, so it's much different than the S&P, not weighted by those mega caps. It just broke out to new highs yesterday after having been essentially flat. The prior high was in February, so never made a new high. That also made us a bit cautious because we like to see breadth underneath the hood expanding. And globally, that frankly wasn't happening until yesterday with that breakout. This is the daily chart, zooming in, and you can see that February high, and then the spring sell-off with the war, and really back and forth action since then, and now it's resolving to the upside. There can be false breakouts. No chart is perfect. There's no panacea in the world, unfortunately, but we have to try to kind of assess the risk reward. So perhaps this sloppy trading environment is behind us, and that should bode well for the momentum factor going forward. Our Baker's dozen of risk trades is still pretty solid at 9 of the 13 indicators that are positive. We will highlight a few things that are on our radar from a risk perspective, but in general, risk appetite is pretty solid. This is the chart rolling up all those 13 indicators into one line, and it corrected, but it held support and is starting to rally off of that support. Here's one sign that we're suggesting is a bit of a cautionary tale. The red line is triple C spreads in the credit market, corporate spreads, so the highest risk spreads, and they're widening quite aggressively. You can see about 7.75% versus the low of 3. The blue line is high yield spreads, so risky, but not the triple C category. That's still quite tight. So it's quite rare for the red line to go up without the blue line following. They usually go kind of tick for tick. So that's a bit of a warning sign. We'll watch the high yield closely to see if it follows, and that would be a risk off sign. But so far, high yield has remained tight. And then another thing that's sort of out of step with the bond market versus stocks, the red line is just the price of junk bonds, so not the yield, but the price. JNK is the one of the tickers that tracks that. And the black line is the S&P. And you can see that there is a gap building there as well. So off of the late March lows, the red line rallied, but not nearly to the same extent as the S&P. And that's a little out of character. You can see in the low in the spring of 25 or October of 23, both lines had these impulsive moves, and that's not the case right now. So those are a couple of the concerns that we see out there. The 10-year yield is still kind of stuck in this messy range, frankly. Every time it tries to break out, it can't quite do it. The 30-year has made a new high, but the 10-year is kind of where people are more focused on. Commodities have been quite choppy due to the kind of ping pong action of oil. So the Bloomberg Commodity Index did hold its 200-day, the thick green line on the pullback, and now it's starting to try to lift again. The commodity breadth is quite strong, actually, still 75% of commodities that go into this index are in an uptrend. We don't have the chart to show you here, but we've shown it before that breadth measure tends to follow leading indicators like the US PMI, which continues to expand and has further room before it gets as good as it gets historically. So, that should underpin the commodity complex. Oil, as I said, is kind of a hot mess here. This is the 27 strip, just this choppy range, call it from the mid 60s to the mid 70s. Gold has finally started to get its shine back, if you will. Very near term starting to break out. This is the weekly chart, and that red line is roughly a 20-month moving average, which is starting to rally off of, which is a good sign. So after a bit of a 30% drawdown, we're starting to stabilize and potentially turn back up. The upside potential, we look at the retracements off of the high versus the recent low. So around 4,600, potentially all the way up towards 5,000 would likely be the maximum. But it looks like that area is finally starting to get back into gear. And there are seasonal tailwinds for the commodity as well. Early August through early October are typically the best time to buy gold. And this is the daily chart of gold zooming in. And indeed, the short-term indicators have flipped positive. So the blue line is the 50-day. This red staircase is that trender indicator that we watch, which just acts as support. And we've broken above those. And the momentum at the bottom clip turned negative. So below 40 is bad. We fear weakness. Above 60 is good. Embrace strength. And that just flipped positive as well. So that gives us more confidence maybe that this is a real turn, at least for a short term. That gives us more confidence that this short term trend has reversed. Copper is breaking out to new highs, which you don't fight new highs in general. The long-term target prices for copper are $8 towards $9.50. And we've compared this in the past to gold. If copper were to get to $9.50, that would be the equivalent of 4,000 for gold after it broke out. And we know that gold kept on going after that, and it's kind of blow off top in January. But the structure of the copper chart is quite sound. And copper versus gold is on the left, the commodities that continues to revert back in favor of copper. And the stocks on the right got to the same sort of spot where they bottomed the last 3 times. And we're not nearly fully mean reverted there. You can see this ratio tends to go from the bottom to the top, at least the last 3 times. So based on that history, there should be more power to copper stocks versus gold. The US dollar was kind of breaking out to the upside, and with the recent Fed meeting, it kind of took the wind out of its sails. So it broke back below that key 100 or 100.5 area. So there's all sorts of support. The big level is 98, but that could again provide a tailwind for gold and commodities and risk appetite in general. I'm not going to go through all these slides today, but hit a few others here. Beta versus low vol. So that had a big run up, driven largely by the semis, and it's on a bit of a yellow light. Took out first support where it's trying to hold, but the momentum is still pointing down after a big run. Sector rotation, this I have a yellow light there, but that's no longer the case. It's corrected and held and turned back up, making new highs, or at least testing them. And this is equally weighted cyclicals, which are industrials, tech, and discretionary, versus defense, utility, staples, and healthcare. Here's the equally weighted sectors off the March 30th low in the US, and tech is still well ahead of the pack. It was starting to come back towards the pack. You can see the blue line at 46% is coming back to life. And below that, the green line is financials, up 21, and then healthcare is next in line, up 18%. So those are the next two areas of strength. Breadth in the US has continued to expand, long-term indicators on the left and shorter term on the right. So despite the choppy market underneath the hood, breadth was actually continuing to rise, which was a good sign, portending to a possible breakout to the upside, which we just got. The weird thing about the market conditions now is that we haven't had a breadth thrust, they call it, in quite some time. So one simple measure is seeing the percent of stocks above their 50-day get very, very low and depressed, say sub 10 or 20%, and then moving all the way back up above 90%. And that hasn't happened in quite some time, really since early 2024. And then another signal we look at is for 4-week highs to spike up north of 50%. That hasn't happened since May of 25. So you usually get these signals more frequently, and it's just because there's been a lot of rotation from one area to the next. You'll have a leading area that falters, and then other areas picking up. This more of a mean reverting market lately. That you haven't seen these thrusts off the low that we just had in March. And breadth in Canada in red versus the US in black has actually been going the wrong way, the opposite direction, sorry. You can see since the March lows, that green arrow, the US continues to improve, and Canada actually was faltering until recently, and that's largely because of the resource stocks. We track every day 3-month highs in green versus lows in red, and we take a 10-day moving average of the spread in blue for a basket of about 800 stocks in Canada. And that blue line flipped negative in early June, and it's close to flipping back positive. So that's something we're watching closely. And just recently, on the left are stocks making 3-month highs as of yesterday, and lows on the right. For the first time in many, many months, we're seeing gold stocks on that list. So that gives us a bit more confidence that this, at least some sort of a trade to the upside after being shellacked in the precious metals, is upon us. Our usual screens here is where the models pick from, and they direct the portfolio. So big caps on the left and small to big caps on the right. We always have toes in the water in both market cap spectrums. And this final slide also just shows the significant amount of mean reversion. So recall that the x-axis is a long-term composite momentum score. There's a bunch of factors that go into it. And short-term on the y-axis, you tend to rotate clockwise. And the fact that the tickers are all spread out so much just shows that there's a lot of changes afoot. So we're always looking, the models kind of try to leg into stocks that are moving out of the rain into the upper left, and then hopefully we see them in the sunshine. So you tend to rotate clockwise around these models. So we'll leave it at that. As always, my contact information, as well as David Jarvis at Corton, who's the PM and IFM of the fund. Have a great day.